Hey folks, Dan Ferry here with your Mortgage Minute. So you've been sitting on the sidelines for a while and you're like, what am I going to do? I know there's a recession coming. Mortgage rates spiked. House prices are out the roof. However, rental prices are going crazy too. And me and my family are going nuts in this little apartment. So what do? Okay, so if you finally decided, hey, I'm going to take the plunge into home ownership based on all the stuff that's going on today, I'm here to help you. Okay, so what I want to talk about today is the mortgage options that you have. So unless you have cash, the biggest piece of this equation when you're looking to buy a house is the financing piece of the puzzle. So our goal in the channel is to educate and inform you guys everything real estate, especially when it comes to the financing options. So today we're going to go over 8 different varieties of loans that you might be able to qualify for, and then I'm going to go over the pros and cons on what might fit your specific situation. So let's get to it. First off, let me explain how I got on YouTube. I've been in the mortgage business currently 33 years, but about 15 years ago, I kept seeing clients calling me, applying for a loan, and I pull their credit and it's like, your credit scores are terrible, but I can't really figure out why. When I dig through the equation, I find out that they've had several collection accounts that they paid off. So I asked, why'd you pay off those collections? They're like, well, the mortgage company I was speaking with said I need to pay them off before I can apply for a mortgage. I'm like, that's completely wrong. What happens when you pay off a collection, it refreshes that collection and in most cases very much hinders your credit scores. So the same thing I see or notice on YouTube and when it comes to mortgage programs. You have people that aren't even in the business that read up or read the guidelines to you, but many of these areas are gray. So my goal here today is to go through some just basic guidelines for you so you get it. And again, I've done this 33 years. I continue to write loans to this day. So I live it, I breathe it, and I know the guidelines, especially the gray areas. So let's get to it. I found this today and it says 8 types of mortgage loans for buyers and refinances. So let's go through this so I can explain some of the terms and some of the mortgage programs with you. So the first thing we come through is number 1 is a 30-year fixed rate. And then the second one is a 15-year fixed rate. Well, obviously it comes with a lower rate and lower payments and all that. But if you were to just look at this caption right here or this article online, you'd say, well, I can get a 15 or a 30-year fixed. Did you know you can get a 10-year, a 12-year, an 18-year? You can get basically anything from a 10-year to a 30-year and anywhere in between in most cases. So basically they're showing you, again, I'm trying to show you the channels or websites that go over some specifics, but they're missing a lot of pieces in between. And my goal is to educate and inform you guys of all this stuff. So when you finally apply for a mortgage, hopefully with us, and I'll give you my information at the end of this video, you get it, or you're placed in a program that's most beneficial for you, not the lender, okay? The next piece on this article goes through an adjustable rate mortgage. Well, I won't say that that's particularly a mortgage program, but I guess it is. It's more of a term. So basically what an adjustable rate mortgage is, well, let's explain first what a fixed rate mortgage is. So if you get a 30-year fixed, let's say, we saw in the last caption, you can get a 30-year or 15-year. So what happens if you get a 30-year fixed rate, you get the loan, nothing ever changes really. Your rate stays the same. As you make payments on your loan, your balance goes down. The only thing that can change in your payment is if you escrow. What I mean by escrow, if you have your taxes, real estate taxes, and your homeowner's insurance part of your payment, every year your homeowner's insurance might go up or down, and every year your real estate taxes might go up and down. So those will change your mortgage payment, but if you don't escrow, your mortgage payment will never change because the rate is fixed. Well, with an adjustable rate mortgage, what happens is it's fixed for a certain dynamic or duration of time, and then it starts adjusting, and that also has a specific time frame as well. So for example, let's look at this, the caption right behind me. You can see there it says a 5/1 ARM right here. Okay, let me explain to you what a 5/1 ARM is. So basically in this case, your rate is fixed for 5 years. You can do a 3-year, you can do a 5-year, you can do a 7-year, you can do a 10-year. Those are the most common terms. So that's the front end number that we see. You'll see in this case, you see a 5/1. So what that means is your rate is fixed for 5 years And then every 1 year after that, it'll start adjusting based on a factor and a margin and all this other stuff. I'm not going to go into details of adjustable rate mortgages. I'm going to do that in 2 weeks on an exclusive video I have coming out explaining what adjustable rate mortgages are and fixed rate mortgages are and which one might be the best suited for you. So that's basically it for that piece of the puzzle. So now let's get to some other programs. But if you noticed in here that we just went over, it goes from a 30-year fixed to a 15-year fixed down to adjustable and then to FHA. Where in the heck is the conventional loans? Okay, so well, I'm going to add that because if you didn't see that on the screen, you might be saying, well, isn't there a normal mortgage out there, not FHA and VA and USDA? Well, yes, there is. So let's go over what a conventional loan is in its easiest, simplest forms. Here, let me explain it this way to you. When would we take you to an FHA or a conventional loan? Well, if your credit score is over 620, you qualify. If your debt ratio does not exceed 50%, yes, I said 50%, not 43, not 47, 50%, conventional loans can go up to 50%. You cannot go to 50.001. It'll be turned down. Okay, so those are the two pieces of the puzzle when it comes to a conventional loan. All right, other pieces of this are some boutique programs in there, such as Home One, Home Possible, Home Ready, and all this other stuff. What those mean, there's a conventional financing normally requires 5% of a down payment, unless you're in one of these programs. What these programs allow you to do is if you're a first-time home buyer or currently don't own a home, you can buy a house with 3% down. So those are the big caveats behind conventional financing. So the guidelines for conventional financing are pretty simple. A 620 minimum credit score, a 50% debt ratio or less, and then there's the criteria of what most people then qualify or don't qualify with or for is when it comes to bankruptcies and foreclosures. They have a longer duration of time than the other programs, such as FHA, VA, and USDA. Okay, so if you have a bankruptcy or foreclosure that's not a long-term out, you might not be able to get a conventional financing. That's where the other ones come into play. So the next one you see right here on your screen is FHA. So what's the pros and cons with an FHA? Well, let me give you the pros first. The pros are you can go down to a 500 credit score. Yes, I said 500. You'll have people say 600, 610, 608, 620. You can go down to a 500 credit score. But before you go yeehaw, there's a little bit of a detriment there. Unless you have a 580 credit score, you would need 10% down. So if you have less than 580 credit score, you need a 10% down payment. Now, once you hit 580 and above, that's when you can hit the 3.5% down payment. That's why a lot of people choose FHA because you need minimally 3.5% down. Okay, so we went over the credit scores. Hopefully I debunked those, that you don't need a 600 credit score, or 620. And your debt ratio can go to 57%. Yes, I said 57%. Those are also where you'll see people going over the guidelines and say, well, you can go to 50. They're wrong. I do this, I do it every day. Okay, so you can go up to a 57% debt ratio. Then when it comes to foreclosures and bankruptcies, there's a longer duration of time, or a shorter duration of time, than conventional financing. So let's say you had a bankruptcy 4 years ago or 3 years ago, and you just don't fit the conventional guidelines. Well, the next best thing, other than us sending you a decline letter, we look at going with an FHA loan. But wonder if you're a veteran. Even better, if you're a veteran and you have not used your VA benefits, I would highly suggest you do so. Why? It's because it'll go up to 100% financing. Yes, 100% financing if you're looking to buy, refinance, or maybe cash out to pay off a whole bunch of high interest rate credit cards, maybe put on an addition or so forth. FHA comes with VA comes with very similar guidelines to FHA, has a shorter duration of time than conventional on foreclosures and bankruptcies, has lower credit standards, and can go up to, usually in some cases, I've even seen approvals go up to a 60% debt ratio. And then the next thing you can see on the screen is USDA. So the first thing I thought is when I got in the business, USDA. I don't really know if I'm going to finance a lot of farms in Chicago, but I was mistaken. The first loan I did was a condominium just about a half hour west of my home under USDA. The benefits there, 100% financing. no money down. That's the best piece of the puzzle when it comes to USDA. So now you can see how there's a whole bunch of variations on, options that you have and why we might place you in a particular loan versus another. And I'm going to summarize that here in a minute. But what I did want to do is go through some other information that they have here. They have jumbo mortgages, and I'll go through that. And then they have interest only. So let's tackle the jumbo mortgage first. So every year, an entity comes out and says, here's how much financing you can get, or here's the loan amount you can get with a conventional loan. So let's just say that loan value right now is $600,000. It's more than that, but I'm just going to use that as a guideline. So what happens if you need $600,001? Well, you now fit in the jumbo package. Unless you're in specific areas such as New York, San Diego, parts of Chicago, and others that has a high balance loan program in between the normal conventional and or normal financing and jumbos. So let me say it this way. Let's say you're in San Diego and you're looking to buy a $700,000. You need $700,000 financing. Well, you're past the conventional financing because it's 600. And again, I know it's not 600. I'm using that for demonstration purposes. So now instead of going jumbo that has completely different guidelines, they have what's called a high balance loan. So basically it works off the same guidelines as conventional financing, but it'll go up to another cap, maybe 700,000, 800,000, 900,000. And then you're in the jumbo programs. Here's why a lot of the programs try to fit you in before you go to jumbo. Jumbo is that area where your debt ratio really plays a key. You can go to 43, sometimes 44% in your debt ratio. And again, remember if we went through all the other programs, you were looking at 50, 57, maybe 60% debt ratio when it goes to the VA financing. But in this case, you're at 43. Then interest only, I'm not going to talk about that right now because that's not mainstream. You can get that in a boutique program or a non-QM program or so forth. So what I'm trying to do is show you even the best of websites don't give you all the information you really need. So I hope you learned something today because again, my goal here is to educate and inform you guys everything real estate. My name is Dan Frio. If I could be of any help to you, if you're looking for a mortgage anywhere in the country, I would love to help. Me and my team are now federally chartered, meaning we can help you anywhere in the country as well as Puerto Rico. So if you'd like to find out more about me and my team, please visit us at therateupdate.com. All the information is here to reach out to us to get some help. So thank you so much for watching. Hope to hear from you. Bye-bye.